Okay, let's dive right into this explainer and unpack how a seemingly niche industrial company just completely crushed Wall Street's expectations in Q1 of 2026. We're looking at Douglas Dynamics today, and we're going to break down exactly how these jaw-dropping numbers came together. Here is a quick look at our roadmap. We'll start with their business model so you know exactly who they are, look at those staggering Q1 financial results, break down the weather catalysts that drove them, analyze their segment performance, check out their shareholder returns, and finally, look at their forward guidance for the rest of 2026. All right, Section 1, let's meet Douglas Dynamics. To set the stage, let's look at what this company actually does. Trading on the New York Stock Exchange under what I think is the absolutely perfect ticker symbol, PLOW, Douglas Dynamics is North America's premier manufacturer and upfitter of commercial work truck attachments. In plain English, they make the commercial snowplows and ice control equipment that literally keep our roads and sidewalks clear when winter hits. And they aren't exactly the new kids on the block. They've got over 75 years of history in this space, housing a suite of really trusted industry brands like Fisher, SnowX, and Western, alongside upfitting brands like Henderson and Dejana. But here's what you really need to remember. What drives their day-to-day operations is their proprietary Douglas Dynamics Management System, or DDMS. This is their operational engine. It's relentlessly focused on continuous improvement, and it's basically the secret sauce that allows them to turn totally unpredictable weather into highly predictable profits. Moving on to Section 2, let's look at those record Q1 2026 results. Look, any business can have a good quarter, but Douglas Dynamics really set a new standard here. They reported record net sales of $137.8 million for the quarter. That is a massive 19.8% year-over-year jump, easily clearing Wall Street's consensus estimates by over 3%. When you're moving heavy industrial equipment, seeing a 20% bump in top-line revenue is just incredibly impressive. But it wasn't just top-line fluff, right? It translated beautifully to the bottom line. Their adjusted earnings per share came in at 36 cents. To put that into perspective, Wall Street analysts were estimating 13 cents. They absolutely crushed it. That's what we call an undeniable beat. And this comparison right here is just brilliant. Net income didn't just grow, it rocketed from a mere $100,000 in 2025 up to $6.4 million in Q1 2026. Adjusted EBITDA shot up 78% to $16.8 million, which pulled their margin up 400 basis points to 12.2%. The takeaway? They didn't just sell more stuff, they sold more stuff way more profitably. Let's move to Section 3 and talk about this snowfall catalyst. So why did demand surge so dramatically? Well, we have to look at their most powerful, albeit unpredictable, external partner, Mother Nature. She was the ultimate catalyst for this quarter. We saw roughly a 40% year-over-year increase in snowfall totals across the October 2025 to March 2026 season. And it didn't just beat the prior year, it tracked about 25% above the 10-year average. Think about it. More snow simply means more plows on the road, more wear and tear, and a much higher need for replacement parts. As President and CEO Mark Van Genderen pointed out, that intense winter weather directly translated into heightened demand for their parts and accessories. But notice what else he highlights here: disciplined execution. The snow definitely brought the opportunity, but it was their management system that allowed them to actually capture it so efficiently. Okay, Section 4. Let's break down the segment performance. We need to see how this builds their overall revenue profile, because the company basically operates in two halves. The attachment segment, which is where the snowplows live, saw a massive leap in sales to $60.9 million, obviously driven directly by the snow. Meanwhile, the solutions segment remained remarkably steady at $76.9 million, producing record bottom-line margins of 11.9%. What's really fascinating about that solutions side is that strong municipal operations, so think city governments buying up upfitted trucks, combined with excellent execution on the manufacturing floor, actually helped offset some slight softness they experienced on the commercial side. It is basically a masterclass in how having a diversified product mix within a niche industry can give you a nice safety net when one particular sector softens up. Section 5. Shareholder value and dividends. So what is Douglas Dynamics actually doing with all this cash? Strong earnings are great, but how does that actually reward you, the investor? Well, management is highly focused on a disciplined capital allocation strategy. They balance three main pillars. They maintain sustainable dividends. currently yielding around 3%. They pursue strategic acquisitions to build out their portfolio, and they actively return cash to shareholders through a $50 million share buyback authorization. And to put their money where their mouth is, right on the heels of these earnings, they declared a quarterly cash dividend of 29.5 cents per share. Between that dividend and their share repurchases, they returned a total of $10.1 million directly to shareholders in the first quarter alone. That shows a ton of confidence in their ongoing cash flow. Finally, Section 6, looking ahead to the rest of 2026. After a total blowout in the first quarter, how are they resetting the bar? Well, driven by that incredibly strong Q1 foundation, management confidently raised their full-year revenue guidance. They bumped the midpoint up by over 5%, moving from their previous target of $735 million up to a newly revised $772.5 million. And that optimism carries all the way down the income statement. They also boosted their full-year adjusted EPS projections by nearly 10%, landing at $2.80 at the midpoint. This is a clear indicator that they expect their operational efficiency and profitability to remain super strong, even as the seasons change and the snow melts. But they aren't wearing rose-colored glasses here. CFO Sarah Lauber pointed out that while municipal momentum is expected to remain really strong, they are carefully managing expectations. They're anticipating some moderation on the commercial side of the business as they keep a close eye on broader economic uncertainty and an evolving macroeconomic backdrop. Which leaves us with a pretty critical question for the rest of the year. They capitalized perfectly on a heavy winter. But if the weather normalizes and commercial economic headwinds start picking up, can their proprietary management system actually maintain this incredible momentum? It kind of forces us to ask. In a business tied so closely to the whims of nature, is it luck that makes the quarter or the operational discipline to capitalize on it when it falls from the sky? That is the real test for PLOW in 2026.